Hello, Econ students. Today we're covering notes 4.3, Saving and Investment. Your essential question: how do investors use risk to determine their saving and investing practices? So first, saving and investing. Investment is the act of redirecting resources from being consumed today so that they can create benefits in the future. So in short, investment is the use of assets to earn income or earn a profit. When people save their money or invest their money, their funds become available for businesses to use and expand and grow. So that way, they're taking their money, someone else can use it, and that way their money will grow and they'll be able to have more of it over time. When savers invest, they receive documents that confirm their deposit or their bond purchase if they're purchasing a bond. These are called financial assets. These represent claims on a property or the income of a borrower. That way, so the institution knows that they have taken your money and they are responsible for it. And then also, you as the consumer then know that you have deposited your money and you have to account for it as well. So, a financial system is a system that allows this transfer of money between savers and borrowers. So, some of you may have a bank account right now. If you have your money in a bank and you put your money in a savings account, that money can then be used by other people. The bank can then loan that money out to other people who want to buy a car or buy a home. They want to have a mortgage, something like that. That money can be lent out to those people, and then they would pay it back with interest as well. Financial intermediaries are institutions that help channel these funds from savers to borrowers. So, like I said, as an example, banks and credit unions, you can do these with banks and credit unions. So, if you want to borrow money from a credit union or a bank, you can do that as well. You can get a car loan, a home loan from a bank or a credit union. And in fact, you're just actually borrowing other people's money, other people's savings that they have put in there. And you can borrow, and then also other people can borrow, and they can borrow off of your savings. But don't worry, your money doesn't go anywhere. Your money will always be safe with the bank up to $100,000. Finance companies also work as a financial intermediary. Mutual funds pool the savings of many individuals and invest this money in a variety of stocks in the stock market. You can also invest in a life insurance company. So, a lot of people have life insurance. They pay a small amount each month so that in case they have an untimely death, their family can then get a cash payout of all of the money that they've been paying into for the life insurance company. And then pension funds are a type of retirement fund that are set up by employers. So teachers have pension funds, so we pay into these pensions. And then once we retire, we will get a paycheck for the rest of our lives from our pension fund. So financial intermediaries accept funds from savers and then they make loans out to investors. That's how the system works. Financial intermediaries do share the risk, so they diversify, they spread out investments to reduce risk. That way, they aren't just investing in one company, and if that company fails, they lose all their money. They also provide information to people who are lending or borrowing money, and they provide liquidity. So they provide savers with the ability to easily convert their assets into cash. So if you wanted to, you could go straight to your savings account and you could collect that money. Savings accounts generally have greater liquidity, which means that you can go and you can take out your money anytime, but they generally have a lower rate of return. So, yes, you can save your money and you can put it in a savings account, but the interest rate that's coming off of that isn't ever going to be very high. A return is the money that investors receive above and beyond the sum of money that they've invested. So you can think of like the interest. So if you were to borrow money from, let's say, your friend, you said, okay, I want to borrow 20 bucks from my friend. And your friend's like, great, you're going to borrow that 20 bucks, but you're going to pay me 10% interest. So that means each week or however the terms are set, you have to pay 10% on what you borrowed. So let's say you borrow 20 bucks, but you have to pay 10% interest. Then when you pay it back next week, you're going to have to pay them $22 back. So that is the return. In general, the higher potential of return of the investment, the greater risk involved. So, if you're putting your money into the stock market, which is a much riskier place to save your money, if you're putting it in there, you are potentially getting a lot more money in return if your stock does well, but you also have a higher risk of losing your money if the stock doesn't go well. So, bonds and other financial assets. Bonds are basically loans or IOUs that represent debt that the government or a corporation must pay to an investor. Bonds have three components. Bonds have a coupon rate, which is the interest rate that the issuer will pay to the bondholder. Bonds have maturity, so the time in which the payment is due. And then the par value. This is the amount that an investor pays to purchase the bond, and it must then be repaid to the investor at maturity. So economists therefore refer to a bond's yield, which is the annual rate of return on the bond if the bond were held until maturity. Investors can also buy bonds at a discount, so they can do that if they would like. We're not going to go into too much detail on buying bonds from a discount. But bonds are also rated, so if you want to determine the quality of the bond that you're going to buy, you can check out the bond rating. A high bond rating usually means that the bond will sell at a higher price and that the firm will then be able to use it to issue a lower interest rate. So we have these different ratings for bond system, the S&P, which is the Standard and Poor bond rating, and then we also have Moody's and the Securities and Exchange Commission. And these help prevent dishonesty in the bond market. So they try to keep everyone honest. And once a bond is sold, the coupon rate will not go up or down. They're not shares or parts of the company like in the stock market. The company must make fixed interest payments even in bad years. So if the company's not doing very well, they still have to pay those. And then bonds can be downgraded to a lower bond rating. So there are savings bonds. Those are probably the bonds you have heard about in your US history classes before, when you've heard of like victory bonds or liberty bonds that we've sold during different war times. So these bonds are issued by the US government. They're usually paid with interest only when the bond matures, so they do take a while, but they're a way for the government to quickly make some money in times of war when we really need extra cash. There are treasury bonds, bills, and notes, which are provided by the US Treasury Department, municipal bonds, which are issued by local or state governments, corporate bonds, and junk bonds. Other types of financial assets, certificates of deposit, are usually available through banks, which use the funds deposited in these CDs for a fixed amount of time. There are also money market mutual funds. These are not generally FDIC insured, so they're a little more risky, but you also have the ability to make a profit off of them, but the profit is often not as high. Financial assets markets. One way to classify financial asset markets is according to the length of time in which the funds are lent. So, capital markets are money that is lent for more than a year period of time, whereas money markets are short term, so they're usually less than a year of time. They also can be classified by whether assets can be resold to other buyers. So, primary markets, they cannot be transferred, whereas secondary markets, they can be resold like stocks. And speaking of stocks, the stock market. The corporations, those big companies that we have in the United States, they can raise money by issuing stock, which is ownership in the corporation. A portion of the stock is called a share. So one share is one tiny piece of a corporation. Stock owners can earn a profit in two ways. So if you buy stocks, you can make money off of the dividends, which are the portions of the corporation's profits, which are paid out to all the stockholders, or capital gains. And these are when you sell your stock for more than what you paid for it. So if you buy a stock and that stock is only $10, let's say you get in really early with Google and you buy Google at a $10 stock, and then later on that stock is worth $100, well, then all of that money that you have now made, that extra $90, is going to be your capital gain. A stockholder that sells a stock for a lower price than what they received it for is considered to be a capital loss. So if you bought that Google stock at $10 and then it ended up being $5 when you sold it, you have a capital loss of $5. Different types of stock that we have. Income stock pays dividends at regular times throughout the year, whereas a growth stock can pay either few or no dividends at all. The company, instead of paying out to everyone, reinvests its earnings into its business so that its business will make more money overall. Decision making differences. Investors who buy common stock are voting owners of that company. So when the company makes a decision, they get to vote on the company's decisions. A stock split is the division of a single share of a stock into more than one share. Stock splits occur when the price of a stock becomes so high that it discourages potential investors from buying it. So let's say that Google stock just skyrocketed and it went up to like $10,000 for one stock. Well, that's going to be a little more difficult for people to buy individually, but people could split one stock and two people could go in and buy one stock together. Purchasing stock is risky because it depends on the economy. It depends on how the stock market is doing. So you could potentially invest in something and then that stock crash and it not be worth very much at all. Or you could invest in something and the business takes off. Like anyone who invested in Zoom before March of 2020, those people are probably feeling very good about their investments right now because who knew the whole world would be using Zoom after, March of 2020. So that would be a really good stock to invest in prior to this pandemic. Stocks are traded on the stock market. So a stockbroker is a person who links these buyers and these sellers on the stock market. Stockbrokers, they work for brokerage firms or businesses that specialize in the trading of stock. Stock is usually bought and sold on different stock exchanges. And these stock exchanges, most popular is the New York Stock Exchange, but there's also the NASDAQ Stock Exchange. So, the New York Stock Exchange is the largest stock exchange. It's happening in New York. Usually, everyone is in person, but not right now because of COVID times. NASDAQ is the high tech and energy stock, so companies that focus on technology and energy. There's the over the counter market for the electronic marketplace that's not listed or traded on an organized exchange. And day traders use these computer programs to try to predict minute by minute how prices will change in stocks in hopes of earning a profit. So, futures are contracts to buy or sell at a specific date in the future. Options are contracts to buy or sell stock or different financial assets. And then, how we measure stock performance. We have what we call bull and bear markets. So when the stock market rises steadily over time, this is known as a bull market. But when a stock falls over a period of time, it's called a bear market. Okay, so rising is a bull, it's like charging, things are going well, it's rising. But when it's falling, it's considered to be a bear market. The stock performance indexes, the Dow Jones Industrial Average, is generally what we look at to see how stocks are doing. So this shows how the stocks of 30 companies are doing, how they've changed in value. So that they look at this and they say like, oh, the stocks are increasing and the stocks are decreasing. We're increasing or decreasing in value in the stock market. And the S&P 500 does the same thing, but it tracks the performance of over 500 different stocks. The collapse of the stock market crash in 1929 was called the Great Crash. The Great Crash was caused because of speculation. So people were making high risk investments with borrowed money and hoping in the hopes of making a big return. So they were like taking out loans to invest in the stock market, thinking they would do well, and then they were losing money, and then they had to pay back these investments with interest for money they didn't have. So we've had massive effects because of this. Now we have much more regulation. Banks are not allowed to just use your money to invest in the stock market. We have to be more careful. And then people became more wary of investing in the stock market after this. So now the FDIC is intact, so your money is protected in banks. They cannot just take your money and go invest it in the stock market. So your money is safe up to $100,000. And that's the end of our notes for today. So don't forget to write a summary, a couple sentences about what you learned.